Hello everyone. January sure has been a hectic month, as we had cautioned. Modeling through such markets can be difficult, to say the least, which is why we're glad to be back to present to you our credit convictions for February. In a nutshell, we are maintaining our defensive approach for most credit segments this month, due to an overall market environment that should remain very volatile for the time being. Indeed, political and macroeconomic uncertainties do not really mix well with an expected elevated supply. We continue to favor short-dated, high-beta instruments to minimize volatility while still earning decent carry, and also some specific subsegments, such as the Chinese high-yield market. Let's start off with the Chinese bond market, where we held and we're still holding a positive view, which has begun to materialize thanks to the gradual and stronger implication of Chinese authorities to contain the real estate credit burst. The central bank, along with other governmental bodies, seem to be tightening their grip on the sector and should be ready to avoid any systemic shock. Let's move on to European credit, both on high yield and investment grade segments, that we continue to prefer against the US counterparts. We believe that the European high-yield market should continue to benefit from technical tailwinds, that is to say, comfortable valuations and more central bank flexibility than in the US. The picture looks less favorable in the US, where demand for corporate bonds is dwindling, along with very elevated volatility levels on both equity and rate markets. A heavy supply of bonds and a lot of M&A/LBO activity make us more cautious on this side of the Atlantic. On the subordinated debt front, you'd better be careful when choosing which type of exposures you want to get for your portfolio. Valuations begin to look attractive, but we're sticking to carry plays with short duration in order to avoid volatility. Bank Tier 1 and Tier 2 bonds are the best way to play this trend in our view. When credit segments tend to be stressed or lose liquidity, ESG-label bonds have proven that they could provide somewhat of a mild relief thanks to a more sustained demand and stickier fund flows. This could be the occasion to see some greenium on ESG-label notes. That's it for our credit convictions. Thank you for your attention and do not hesitate to contact us for any further information.